Hello, everyone. Today on the Final Bar, welcome back from the long holiday weekend. We'll be talking with Pete Carmasino of Chaikin Analytics. We'll talk about this narrow leadership trend that continues with the small number of names, but the largest names doing the lion's share of the gains. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activities in markets using the power of StockCharts. The StockCharts platform was designed a number of years ago to empower investors to better understand the markets, better follow trends, and anticipate trend reversals. We're in this interesting situation where trends just seem to keep persisting, right? Some of the leadership names like NVDA, the FANG stocks continue to push higher. Bit of a concerning candle pattern on some of those leading names, which we'll talk about through the course of the show today. But overall, a lot to like. It feels a little bit, to be honest with you, a little bit late 90s. I feel like if anyone adds AI into their company name, that's an easy 5-10% bounce in your stock these days. That has me a little concerned. But at the end of the day, the charts will tell you when a trade like that is working, when it's no longer working. So the best argument I think you have in these sort of markets is to follow the trends, and we've certainly seen where they've been. We'll look at some of those charts and some of the movements in the fixed income markets as well. Let's get to our market recap and talk about some of these moves in the key charts. Do want to start with a poll. We always have a poll going on our live stream page at StockCharts.com, also on our social media accounts. I actually tripped up Final Bar Nation this week. I don't know if I'm proud of this or not, but I did it. I asked you, know your technical indicators. Which one is based on the average up closes versus average down closes over a period of time? 27% of you correctly answered RSI. That is the foundation of the RSI indicator, the relative strength index. When you think about why it's such a good measure of price momentum, that's because it starts with a simple comparison. Looking at the last X number of days, how many, when we closed higher, how much higher did we go? When we closed lower, how much lower did we go? And it's a ratio of the average up day to the average down day. Then it uses some exponential smoothing to make it a little less painful over time, a little more smooth of a calculation, but that is the foundation for it. The ADX line is actually a measure of strength, and if you're not familiar with that indicator, a number of you guessed that one. Go to Joe Rabel. His show deals a lot with ADX. It's one of the indicators he uses often. He does it well. 10% of you said DK up-down bands, which I just made up for the question, but I'm now thinking I should totally create an indicator with that title, and I'll get at least 10% of you responders to use it. But thanks so much for answering that poll. If you want to know more about indicators like RSI and ADX, go to our chart school. It's a free part of the StockCharts platform, has all of those answers and much, much more. Let's continue on with our market recap. The S&P, as I alluded to, you're still seeing that leadership, but what's so interesting is at the end of the day, what did our major averages do? We're back to kind of a familiar pattern. The NASDAQ up a bit, the S&P flat, the Dow down a bit, and that's sort of how the day ended up by the close. The S&P closed just above 4,200, just narrowly. It bounced right into the close to close the day at 4,205. That's about where it started about where it ended the day on Friday before the long holiday weekend, that is. The Dow down just a little bit, about 0.2%. The NASDAQ up about 1/3%. The NASDAQ composite just above 13,000. Mid caps down, small caps down, probably the most of this group, down about 0.5%. The VIX moving lower as well. So you had a choppy sort of session, but volatility coming in. And again, I think still an open question about what the VIX is like going forward. I think we have a lot of data about what the VIX has been. Now that we have the options market changing, we've got the 0 DTE options, we've got some other measures of volatility to contend with. I think still an open question, but for what it's worth, the VIX currently down around 17.5, which is, low volatility. If I had to generally, bucket that into low or high, it's certainly low volatility, particularly relative to the last 12 to 18 months. Let's look at some other asset classes and see what we can see. Interest rates overall moving lower today, 5, 10, 30-year points all pushing to the downside. 10-year yield finishing around 3.7%, long bond yield around 3.9%. This is last week. We're talking about rates pushing a little bit higher with the long bond yield around 4%. Now coming back a little bit from where we were as bond prices moved higher. The TLT, which is a treasury bond ETF, sort of long bond ETF, up about 1%. The dollar index, not too much of a change from Friday. And again, that's using the ETF space. UUP was the ticker there. Looking at commodities, gold up, everything else lower. Energy continues to be one of the worst performing sectors. Year to date, it's certainly been one of the worst places, relative to previous parts of the cycle where it's been particularly strong. Energy struggling. We had a great conversation last week with Doug Bush about energy and about thinking about some potential rotations and where to look. For now, continue to feel some weight in that sector. Gold actually working here, and gold stocks have been pulling back quite a bit here in the last couple of weeks. Arguably, you could make the argument gold's at the lower end of a trend channel coming off of the lows, but that's going to make sense if gold rallies from here. So today, a bit of it, but we'll have to see if there's more for that gain. That would probably be more of a defensive play, would be my guess. If the growthy indexes start to come down a bit, you could see gold popping. So for today, what it's worth, gold actually having a decent day. The GLD up 0.6%, silver not as much, down about 0.4%. In crypto land, mostly in the green today. And some choppiness over the weekend. Ether just above 1,900. That's up 0.7%. Bitcoin around 27,850. Let's go to a chart of let's look at sectors here really quick while we're on the page here. Consumer discretionary, technology 1 and 2, and we'll keep that in the back of your mind. I know when I talk to today's guest, Pete Carmasino, we'll talk about some of the leadership trends, some ratio analysis to really illustrate the leadership trends and shifts in a very beautiful way. Today, XLY and XLK at the top of the list, followed by real estate, sort of an interesting third from the top, tends to be a little more of a defensive sector. On the bottom, it's some defense. Consumer staples, number one, the worst performing sector, down about 1.1%. So one of the classic measures of offense over defense that we look is consumer discretionary versus consumer staples, things you want over things you need. Today, for what it's worth, very much pressing that bet of offense over defense. And that ratio has certainly been dipping higher after going down and certainly not supporting the uptrend that we'd seen in the equity indexes. Now starting to rotate higher, and that's been a reversal that we've seen over the last month or so, a bit of a rotation back to consumer discretionary, away from staples. And a lot of that are stocks like Coke and Pepsi and PG and others rotating off of their previous swing highs. Let's look at a daily chart of the S&P 500, just see what happened today. So interesting that we sort of gapped higher at the open of the session here. And so earlier in the morning, when I'm looking at the sort of doing my morning coffee routine, looking at the chart of the S&P, certainly felt like a significant breakout. I was sharpening my pencil, getting ready for the, lights out, we're breaking out sort of announcement. It didn't really happen. It didn't play out that way. By the end of the day, the S&P is sort of right where it started. So this all of a sudden feels a lot less optimistic, right? Where you open higher and actually trade lower through the course of the day. I'll show you a couple candle charts here in a second that sort of back up that short-term sentiment. So for now, right, when the S&P, when a major index tests a key resistance level, I think 4,200 is a pretty important one, because that's the high from February. We failed just barely to get there at the end of April. Mid-May, we actually got right up there and pulled back. Now, once again, on Friday, we're powering right up to the 4,200 level. Today, we open higher, but then trade back lower. So you're not really getting that upside follow-through, representing that additional buyers are coming in. This actually feels like people are selling on the gap higher out of the open. So interesting. I would say that this level is still in play, right? The follow through would be additional buying power pushing prices above 4,200. I don't know if that's the takeaway I would have from this chart in particular. And what's interesting is if we look at a couple of the names that had been moving higher, like in Amazon, for example, you're seeing a bit of a rotation lower, at least a little bit of an interesting dynamic to the day today. Actually, Amazon wasn't the one I was thinking of. Apple's the one. Let's look at a candle chart of Apple here. We don't talk a ton about candle charts, but I find that candlestick analysis is a great complement to the normal analysis I do, which is a little more medium term to long term, focusing on trend following, focusing on momentum shifts. But when I have a shooting star candle, which is how I would describe the chart of Apple today, that's where we open, we trade higher, we close back near the lows, not much of a lower shadow or lower stem, a long upper shadow. That's called a shooting star candle. And it basically sort of implies what the name illustrates or suggests, which is, something coming down, sort of hitting a high level, but then coming back down to earth by the close. Short term, that's a little more of a bearish sign than a bullish sign. But again, that could be immediately eliminated if we break above the high of today, above 179. So for now, you're seeing some of those mega cap growth stocks with a bit of a bearish candle pattern. That is a short-term signal. The long-term trends still very much in play. And I think that's the question for a chart of Apple is, do you keep making higher highs and higher lows? You can have a pullback, still make a higher low, and this continues to be a trend that persists for quite some time. It's more about stepping back and looking at the change in trend over time, I would argue, on a chart like Apple or Microsoft, any of those leadership names. Speaking of leadership, you have a similar sort of a shooting star candle today for NVIDIA, but I think the story is more about this trend that has happened. I mentioned in the introduction, I feel like anything with an AI component, whether it is a legitimate AI focus or they just can somehow get it into their marketing materials very quickly, it's causing short-term demand to certainly spike up there. NVIDIA last week having a really strong week, gapping higher 20-25%, finishing strong today, gapping higher yet again, although it closed at the lows of the day, still again in a decent uptrend. And sympathy names, sort of similar movements today. Palantir, PLTR, up almost 8%. It was up a little bit more to $15. Settled down just a little bit going into the close, but still pretty strong. And C3.ai up 33% today, powering above resistance. That has a very cryptocurrency sort of look to that particular chart. So what's interesting is you have some of these speculative names continuing to work. You're seeing gaps higher on some of those names. Charts like Tesla having a strong move, up another 4%, closing just above its 200-day moving average. My question on any of these names, do you have sustainability, right? Do we break above a resistance level and actually follow through? That's what the S&P has not quite done. That's what I'll be looking for on the chart of Tesla. That's it from our market recap. Before we get to the break, just want to let you know quick news. William O'Neill passed away this weekend. If you did not know Bill O'Neill, he started William O'Neill and Company in 1963, started Investors Business Daily, which was a daily periodical in 1980. Getting started in the industry in 2000, I read IBD every day, bought it at the newsstand, and that was how I learned a lot about stock picking and equity analysis and the CAN-SLIM method, comparing the big picture to the small picture. Bill O'Neill was a master at combining fundamental and technical analysis in a way that I know Mark Chaikin and others have done so well at moving that forward. But it really started with people like Bill O'Neill writing books like How to Make Money in Stocks, which continues to be one of the top things that I recommend for new investors. So rest in peace, Bill O'Neill. We'll be back in a minute. Hey everyone, welcome back to the Final Bar. I'm Dave Keller here at StockCharts.com. We so appreciate you joining us every weekday after the close for our show. I'm going to bring on today's guest, Pete Carmasino, here in a few moments. Before we get there, I'd love to invite you to send us questions. We'll do some mailbag segments over the coming weeks, and we'd love to feature one of your questions live on the air. Our email is thefinalbar@StockCharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our StockCharts TV YouTube channel. We'd love to hear from you. We'll hope to answer your question live on the air in our next mailbag segment. Upcoming guests tomorrow on Wednesday the 31st, Mike Singleton, the founder of Invictus Research, is going to be joining us for the first time. Good macro strategist who I met just recently in New York. I'm excited to bring some of his takes with all of you. Thursday, we have Leslie Juflas of Trading Live Online joining us live from our studio here in Redmond. On Friday, I will be off. I'm traveling to Cleveland, Ohio to visit some family. Jay Woods has genuinely offered to host the show remotely from Freedom Capital Markets at the NYSE. So tune in live on Friday, June 2nd. I want to welcome on today's guest, Pete Carmasino. Pete is the chief market strategist at Chaikin Analytics, hosts his own show on StockCharts TV, which is just very, very well done. Coming to us from Tampa, Florida. Pete, how are you? It's good to see you again.
Great seeing you. Thanks for having me. And what an incredible beginning of the show. Some excellent information. Love listening to you every day.
You're kind to say it, Pete. I appreciate it. Help us make sense of these things if you could. I've gotten the table set, and now we're ready to eat the meal with you and see what we can see about things. We're starting with your chart of the dollar. You wanted to start there to just talk about the overall conditions. Talk us through what this chart means to you and to your process here.
Absolutely. And, you brought up Bill O'Neill, and I also started in the business and read at IBD every day and really learned, again, the fundamentals tell you kind of what, technicals tell you when. And when you're watching these particular situations play out, I wrote a pen to piece in December of 2021 about avoiding bonds. Bonds are, with an anticipated rate increase on the table, bonds will be affected. And so is the dollar. And when the dollar is affected, you're going to see that rise, obviously exponentially over time, because there was an anticipatory feeling to the market. Everyone was expecting it. It wasn't quite as fast as they thought to start, but then it really started to escalate. And I always say this, that the bond market's not going to sit around and wait for the Fed to raise rates. It's going to react. And we had a target on TLT on the downside of 97. It surpassed that, went all the way down to 90, and then kind of has really kind of flattened out around that 100 to 105 level. But this dollar move was, again, the correlation you can see down at that bottom part where we're looking at the US dollar correlation to the secured overnight, the Fed lending rate, that overnight rate at the Fed. And when it peaked right there in that November area, the correlation dropped dramatically. Obviously, the dollar pulled back. And what did we see? We started to see the markets bottom out and start to really consolidate between October and November and really started to move higher. I guess that's really the last low that's been put in and yet to be tested.
It's so interesting how the dollar, and I feel like in 2022, the dollar chart, arguably the most important chart to see. I mean, it told the story. We called it at that time the wrecking ball for risk assets. So yes. I'm a little concerned when I see the dollar start to turn higher again. But great chart, particularly showing the correlations there to the SO for the secured overnight financing rate. Let's talk about growth versus value, and we're looking at the mega cap versions of that ratio. This is a beautiful way of really demonstrating the rotation and leadership. Talk us through this one.
Again, same situation. You can start to see how that, back in that 2021, the end of 21, it started to kind of plateau and then start to roll over. Again, when things started to really escalate in the inflation fighting, with the rates rising and obviously bonds starting to fall off. And everybody knows this, but I think it's worth repeating. A lot of people forget that it's really bond prices that make rates move, right? So when bond prices are selling off, rates are going to rise. And what happened? That's a headwind for mega cap tech. It always has been. It always will be, because look, their discounted cash flow, the risk, the free risk-free rate is obviously elevated, and those earnings are worth less in the future. So there was that macroeconomic situation. There was the interest rate situation. There was the fundamental situation. Everything was kind of breaking down. And now you're seeing that sort of consolidated, bottomed right around the end of 2022, starting in 2023. And I think on the next chart, we'll see, several situations where actually might be the last chart, but we'll get there eventually. But we started to see where mega caps started to really start to break out. And we had it as, we do sector rankings as well with our Chaikin Power Gauge. And I think it was XLK that really started to change trend right at the end of February. And again, it's obviously loaded with mega cap tech. But again, value is just getting sold off. And that's why you see that ratio dramatically making a change.
Yeah, and it's really accelerated here recently. Some of those staples names that have been doing really well, kind of rolling over. Some of that, and energy and financials. I mean, a lot of these areas have been struggling the most. Your next chart, I love this ratio of the Qs versus the XLP. Sort of further adds to this this differentiation from offense over defense, right?
Absolutely. Again, you hit it on the head in the beginning of the show where you talked about needs versus wants, and obviously, the needs part of this sector is consumer staples. But again, the tech heavy NASDAQ, we know them, as the NASDAQ 100, the Qs, which have been around for quite some time. You can start to just see when that gains traction, you're seeing people sort of leave the defensive area. Now, we know it's not absolute. This is relative performance, but at the same time, it's just obviously one over the other here. And the Qs have been winning the battle here since that last crossover. And it's just a simple 50-day over the 200 up and down. So you could see when it starts to change, the markets stall a little bit. It's not a perfect indicator, but for me, it's a confidence indicator that the trend is in effect, and it really is changing. And we're early on the stages here, so you could see sometimes this goes for years until it starts to have a sort of a dampening effect. But that one area where we remember in 2018, late 18, the Fed was raising rates, and what happened? The market sold off, and things kind of stagnated a little bit. But off to the races again, with the hiccup there in 2020, which is one of the last times we met. Right. We saw each other in February 2020, and then it was off to the races. But I think it kind of fits well. It's a little hard to read. We kind of squeezed it in there several years, but it's kind of interesting to me. It's a confidence builder for me on the trend.
And it just continues to be. A lot of these trends just certainly are showing that they're continuing, right? I mean, and I feel like the charts will show you when those trends are over. They're not necessarily showing it yet. Your last chart is looking at defensive ratios. I feel like we flipped the previous chart upside down for this one. What does this mean that the ratios are underperforming to this degree?
Again, it's pretty interesting. You could see even if you pull your cursor back to the beginning of 2022, you're seeing the opposite effect, right? These got into a bullish situation on the ratio. And again, it's just the sector over the SPY. The SPY is the S&P 500 ETF. And we saw a nice rally moving higher. And then we started to see a breakdown. I drew that vertical line on each one of the segments there. You know, how the top one is healthcare, the middle one is staples, the bottom one is it should be utilities. But the idea is that they're all kind of breaking down around the same time. They all kind of popped under that 50-day moving average in the beginning of January this year. Again, that's when risk on really took hold. And again, to me, this is telling me that there was traction in that because there was sectors being sold, proceeds trade, right? Take the proceeds from defense and put it on offense and let's get rolling, because that's really what happened. That's what happened in the markets. And once you started to see inflation mitigate, it's not coming down. We're not in a deflationary situation. It just stopped going higher, right? And so that's all we needed to see to maybe tap the brakes on rates, and then mega cap and a lot of the tech stocks that we see today have started to run.
So how would you think, and I'm curious what you guys, how you guys would at Chaikin would approach sort of some of these charts like NVIDIA and others that have had such a run so far. I think the concern for a lot of investors is you missed it, right? And all of a sudden now what do you do? Do you wait? So how do you approach a chart like this? And some of these leadership names have already had such a progression to the upside. What now? I mean, how would you approach them today?
It's an interesting question. And it's funny, you said in the beginning about AI being the .com of 2000, right? I mean, that was unbelievable. You put a .com on your name and everything was running. Yeah, right. Some names, those companies didn't even exist for months after that. But I think it's the same thing. I mean, look, AI is super interesting. It's absolutely going to enhance a lot of things, right? I mean, think about just in general. We talk about Netflix and things of that nature. You watch a movie, then it recommends movies based on what you watch. So it's learning over time. And that to me is really the key. So NVIDIA is obviously the picks and shovels play, right? They're creating this, they're making this happen from gaming all the way to autonomous driving and everything in between. And so NVIDIA, look, we know this from a technical standpoint. Is this a blow off top? I'm not exactly sure, but I'm looking at the chart here on Chaikin, and it is well above our risk bands. Right. And we would say that this is something that if you didn't own it, obviously you missed it. But on a pullback and a consolidation, there could be something there. But valuations kind of get in everyone's head. But I think at some point, we say this all the time, and you know this, that sometimes great stocks don't go up, and stocks that have bad valuations go up tremendously. And we can't understand why. It's not our job to understand why. Our job is to follow that trend, kind of be predictive based on the technical indicators that we see. But NVIDIA in general is kind of that area that, that's the flagship. There are other names that could continually do well, but that's where you start to, I would think, lag into them a little bit, sort of dollar cost average, get exposure to the big tech names, but do it at a slower pace. It's going to be volatile. We know that for sure. Geopolitical, debt ceiling, all the other things you can add in the mix are always going to be the noise there, but the trend is the trend. So just, be patient and kind of leg into these things.
We only have about 30 seconds left, Pete, but I'd love to ask you, out of all the things we've talked about the dollar, we talked about the performance of the leadership, some of the defensive sectors. If you had one of those to use as a way to measure when this strong uptrend is no longer in play, which of those would be most important? What's the guidepost you think is most meaningful to track to see when this uptrend may be over?
Yeah, I think it's rates. I mean, and rates really affect everything, and they're all connected. I think we have to remember that. Everything is connected. The dollar's connected to rates. Rates are connected to bond prices will push rates, and rates will move the dollar. And so it's this circular movement that you kind of have to pay attention to one versus the other. But in general, fixed income is giving equities a run for their money now. 5% rates are pretty good. People are kind of still on the sidelines. So I think you're going to start to see money may potentially flow out of bonds eventually. And then you're going to see, obviously, the equities continue to roll.
Pete, fantastic take. I really appreciate you sharing these charts. You made ACP look really good with some of the ratios you were showing, so I appreciate it. Stay safe. Be well there in Florida. We'll talk to you again soon, all right?
Thanks for having me. I really appreciate it.
That's Pete Carmasino. Pete's the chief market strategist at Chaikin Analytics. Pete's awesome. I mean, just great experience in the markets. And I love how getting a chance with someone like him to just take a step back and look at how some of these ratios have progressed. We can argue so much about what might happen, what should happen, what could happen. At the end of the day, following some of those key ratios and tracking what is happening, arguably the most important thing you can do. Great take there from Pete Carmasino at Chaikin Analytics. We need to wrap our show, folks, and go right to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. I keep trying to find new and exciting ways to sort of illustrate the leadership condition, how I would describe the narrow leadership. And again, is it a bad thing that a small group of stocks are doing particularly well? No. And if you're holding something like the NASDAQ 100 or even the S&P, you're probably just fine with the strength that we've seen in there. My concern is with the longevity, with the sustainability of a move when there isn't enough participation, where it feels like the privates, right, the infantry are now participating along with the generals. Here's the performance of 3 ETFs since the peak in February of this year, right, the S&P's peak. The S&P from the February peak, about 1.2% higher. And again, sort of chopping around here in the last month or so, but overall up about 1.2%. The NASDAQ 100, the Qs, up 12.5%. The equal weighted S&P is actually down 8.7% over that same time period. So if it feels like your portfolio doesn't look like the chart of NVIDIA, it may be because you're holding anything but those NASDAQ 100 names. The rest of the market overall has been sort of flat to quite challenged. Chart number 2, what do you think of this chart? I would argue sort of a cup and handle like bottoming pattern. Arguably, it's after a pretty good sell-off through the middle of 2022. A double bottoming pattern, I think, bottomed in the end of October, rotating higher, a clear higher low, really close to breaking above resistance around 45, and relative strength, strong outperformance. Good chart or bad chart? I would argue a pretty constructive chart. Here's the problem. This is DVN plotted upside down. One of the common techniques to sort of break away from your preconceived biases about a chart, put the little minus sign before the ticker. That'll invert the scale and just look visually. Analyze the chart like you would any others. What do you think about this setup? And a lot of times this can be helpful to help you understand what phase a particular sector is in. I'm concerned at how good the inverted charts like DVN and other big energy names look at the moment. And again, the more that continues to go down, strength begets further strength. Weakness tends to beget further weakness. DVN and other energy stocks appear to be going lower. Finally, a chart I'm just calling 3 candles. This is NVIDIA on the top, Apple in the middle, Amazon on the bottom. Just wanted to highlight the fact that all 3 of these stocks are giving a bearish candle pattern today. With NVIDIA and Apple, that's called a shooting star candle. It's where the open and close are near the bottom of the range. You have a high upper wick and very small low to no lower wick. It doesn't matter if the open or close are higher, so both of these are shooting star candles. This is actually called a hanging man, which is sort of flip that upside down after an uptrend, high and low, and then the open and close near the upper end of the range, also negative as well. Could be some short-term weakness in some of these leadership names showing a bearish candle pattern today. Folks, that's a wrap for our show today. Special thank you to Pete Carmasino from Chaikin Analytics joining us from Tampa, Florida. All of our previous interviews are at StockChartsTV.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a good night. See you tomorrow.